The global economy is once again focusing its attention on the United States. Every decision made by the U.S. Federal Reserve, especially regarding interest rates, has consequences that go far beyond American borders. From stock markets and cryptocurrencies to mortgages, business investments, and even the value of currencies around the world, the direction of U.S. monetary policy influences billions of people. This week, investors are closely watching new economic signals from the United States, especially employment data and inflation numbers. Recent weaker-than-expected labor market data has changed market expectations about what the Federal Reserve may do next. Some investors believe the weaker economy could reduce pressure for higher interest rates, while others warn that inflation remains a serious concern. But why are interest rates so important? Why does a decision made by a group of policymakers in Washington affect people living in Europe, Asia, Africa, and other parts of the world? To understand this, we need to look deeper into the relationship between interest rates, inflation, economic growth, and financial markets. What are interest rates, and why do they matter? Interest rates are essentially the price of borrowing money. When a person takes a mortgage, a company borrows money to expand, or a government issues debt, interest rates determine how expensive that borrowing becomes. The United States Federal Reserve, often called the Fed, controls the country's main short-term interest rate. Its main responsibility is maintaining economic stability by balancing two major goals: keeping inflation under control, supporting employment and economic growth. The Fed usually tries to maintain inflation around 2% over the long term. When inflation becomes too high, the Fed increases interest rates. Higher rates make borrowing more expensive, which reduces spending and investment. The goal is to slow down the economy and reduce price increases. However, when the economy becomes too weak, the Fed can lower interest rates to encourage borrowing, spending, and investment. In simple terms, higher interest rates cool the economy. Lower interest rates stimulate the economy. Two. Why are markets watching the Federal Reserve right now? The biggest question facing investors today is: will the Federal Reserve continue raising interest rates, keep them unchanged, or eventually start cutting rates? This question has a huge impact on financial markets. Recently, economic data showed signs that the U.S. labor market may be losing strength. A weaker jobs market can reduce inflation pressure because companies may slow wage increases and consumers may become more cautious with spending. Recent reports showed unexpected weakness in employment numbers, causing investors to reduce expectations of another rate increase. For financial markets, this creates an interesting situation. Normally, bad economic news is negative for stocks. But sometimes investors react positively, because weaker economic data can mean the Federal Reserve may become less aggressive with interest rates. This creates a situation known as bad news is good news. If investors believe interest rates will stop rising or begin falling, they often become more confident, because cheaper money can support businesses and stock prices. Three, how interest rates affect the stock market. Stock markets are extremely sensitive to interest rates. Imagine a technology company that wants to build new data centers, hire engineers, and develop new products. If interest rates are low, borrowing money is cheaper. Companies can invest more. Future profits become more valuable. Investors are often willing to pay higher prices for stocks. But when interest rates rise, loans become more expensive. Business expansion slows. Investors may prefer safer investments like government bonds. This is why technology companies, especially companies connected to artificial intelligence, are closely watched during interest rate changes. The current market environment is also being supported by strong corporate earnings and optimism around artificial intelligence-related growth. Four, the effect on ordinary people. Interest rates are not only about Wall Street. They directly affect everyday life. For example, mortgages. When interest rates rise, buying a house becomes more expensive because mortgage payments increase. A family that could afford a certain home at a 3% mortgage rate may struggle to afford the same home at a 7% rate. Savings. Higher interest rates can be positive for savers because banks may offer better returns on savings accounts. Businesses. Small businesses often depend on loans. Higher borrowing costs can make it harder to expand, hire employees, or purchase equipment. Consumer spending. When credit cards, car loans, and personal loans become more expensive, people usually reduce spending. Because consumer spending is a major part of the US economy, interest rate changes can influence overall economic growth. Five, why the US economy affects the whole world. The United States has the world's largest economy, and the US dollar is the world's most important reserve currency. When US interest rates rise, global investors often move money into US assets because they can earn higher returns. This can strengthen the US dollar. A stronger dollar affects other countries because many international transactions, including energy and commodities, are priced in dollars. For example, a stronger dollar can make imports more expensive for countries with weaker currencies. Emerging markets with dollar debt may face higher repayment costs. Global investors may reduce investment in riskier markets. This is why central banks around the world pay close attention to decisions made by the Federal Reserve. Six. What happens next? The future direction of interest rates depends mainly on three things. Inflation. If inflation remains high, the Fed may keep rates higher for longer. Employment. If unemployment rises and job growth slows significantly, the Fed may consider lowering rates to support the economy. Consumer confidence. If consumers reduce spending, economic growth could weaken. Investors are currently watching upcoming inflation reports and economic indicators to understand the Fed's next move. The challenge for the Federal Reserve is finding the correct balance. If it raises rates too much, it could damage economic growth. If it lowers rates too quickly, inflation could return. Conclusion. The global economy is currently at a sensitive moment. The direction of US interest rates will influence financial markets, businesses, governments, and ordinary people around the world. The Federal Reserve faces a difficult decision: control inflation without causing unnecessary economic damage. For investors, the question is whether the US economy is moving toward a soft landing, where inflation falls while growth continues, or whether stronger economic problems could appear. For ordinary people, interest rates affect the cost of homes, loans, savings, and daily expenses. The coming months will be shaped by economic data, especially inflation and employment reports. Every percentage point, and every decision from the Federal Reserve, can create waves across the entire global economy. The world is watching the United States because in today's interconnected financial system, a decision made in Washington can influence markets from New York to Amsterdam, Tokyo, and beyond.